Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here on Options Guide TV. We're going to review the trade that we put together on Friday ahead of Lowe's, the, the retailer Lowe's, and their earnings report tomorrow. And then we're going to look at an SPX trade for this week. I think the markets are kind of settling in a little bit. We're getting into the seasonality of the marketplace, the one time of year where volatility has proven to raise its head time and time again, which is September and October. So we had the downturn in August, obviously. And well, I mean, if you took a long nap, you might have missed that downturn because the markets have already taken almost all of it back. So the pundits are trying to decide if this was a crash, was this just a rebalancing of things? Like, what exactly was it that happened in August? It scared the Fed. Everybody for one day was calling for an emergency rate cut. That didn't happen. Thank goodness. Honestly, it would have really thrown the markets off. The Fed is going to be, they have their big Jackson Hole conference at the end of this week, and Chairman Powell will be speaking on Friday. Now, it's not an official meeting. There's no actions that are planned as far as rate cuts are concerned, but it will probably confirm in September. And everybody be trying to get some hints as to, are we going to go 25 basis points or are we going to go 50 basis points as far as the Fed funds rate is concerned on the cut in September? It's widely understood that there is going to be some type of cut. And then also the number of cuts going forward into the end of the year and the beginning of 2025. So if you look at the markets, they're still strong. You could say a little bit of weakness in the tech stock, but NVIDIA has their earnings report coming out, and they're still, if you had the opportunity to buy it at 100 for about a second, and now this market is all the way up, and it's up about 20% since that bottoming out of NVIDIA not that long ago. Okay, so the VIX is down to the 14 level. We did a lot of bearish VIX butterflies that worked out very well. And once again, the VIX is a beast that if you sit and think about the trade, it's probably gone. And that is really what happened with a couple of those trades. We put them all together on Options Guide TV. They were broken butterflies, which actually gave us more the potential to be profitable if the market just continued on down. So it was a truly bearish butterfly. We did two of them in the VIX index. And next week, I'm going to look at the seasonality of the VIX. We're going to talk a lot about the VIX. I'm going to post this article that I meant to post before I actually got sickly. And I'm going to look at VIX trades in September and trying to see if we're going to get that volatility again. It's going to be a speculative trade. When you're talking about the VIX, everything's speculative. Going on a little bit longer in time. The VVIX has came back down to the 100 level. So we have the VIX down around 14, but we have the VVIX, the actual implied volatility of the options that are in the VIX index still staying fairly strong. So buying VIX options is fairly expensive. 100 isn't a ridiculous area, but then again, the VIX is down below 15. So it's interesting. So next week is going to be all about that VIX. This week, we're going to look at our Lowe's trade for tomorrow. And this is we got bullish on it. And we did, once again, the butterfly where we just broke off a wing, paid a little bit more for it, which gives us a little bit more upside on the trade if the earnings report is perceived as good and the market actually does go up. And then we're going to look at just an SPX trade, basically, more of a neutral trade this week. Wondering, waiting to get to next week so that I can start talking a little bit about the VIX. But I think the marketplace kind of just settles in a little bit this week, and I want to try to take advantage of that trade. So here we go. Let's go to the Tradier Pro software. And we see that I have lows up right now. LOW is the symbol. And this is a trade that we set up on Friday. And as I normally say, if you're going to do a trade that is based off of the earnings report, you will usually set it up closer to the date that the company is going to announce earnings. So right now we see Lowe's is actually up today. It's 242.31, and I think it made a decent move on Friday, a little bit to the upside too. So we set up this trade at, as always, around 11 o'clock Eastern time on Options Guide TV last week, and the market has actually gone with it. So when we looked at the Lowe's trade, let me grab my graphic here. We were at 239.48, and we're now at 242.38. Okay, so went up a little bit on the close on Friday and a little bit on the open today. Here's a trade that we set up. We said we're going to do the August 4th expiration, the nearest term expiration. And I'm always going to kind of do that if I'm doing butterflies around earnings. If you're correct on your forecast, you want two things to happen. You want time decay to happen. You need the option contracts that you sold in the middle strike. You need those option contracts to wither away. And it can do that by implied volatility coming in, which usually is the case after earnings. And also, you can just get good old-fashioned time decay. So they're announcing on a Tuesday. That means you got all day Tuesday, all day Wednesday, all day Thursday, all day Friday before these option contracts expire. Lowe's is a fairly hefty stock at 242, so there is some juice in it just because of that. But if we're correct on our forecast, we want time decay to go away. And that's also, if you're incorrect on your forecast, you want it to stay. You want it to be sticky. You want implied volatilities to stay up. You want time decay to slow down. So if you're incorrect in your forecast, you might have a chance to get out, depending on the severity of the incorrectness to the downside. But ideally, this is a trade that if you're doing it, you got to be prepared to lose what you paid for the trade. Because if the earnings are perceived as bad for the company, you don't have much time value to adjust the trade to do anything with that trade. Okay, so let's look at it. Here's where we're at. Lowe's is at 242.61. When we put on the trade, it was below 240. We bought the 245 strike calls. Once again, I'm going to highlight this is the August 23rd expiration, and I always check inside the options grid by looking over in this corner, making sure that those match up. We then skip. Well, ideally, we just did 5 points wide, the 247.50 strike here. Now, the normal butterfly would be to buy the 255. So 5 points wide on our long call spread and 5 points wide on our short call spread. We stop short. We buy the 250. It's a more expensive option contract in this scenario, 171 by 145. So it is more expensive than this option contract. So it adds cost, but it also greatly increases our area of profitability on the trade. When we put the trade on Friday, it was trading at 104 at the midpoint, $1.04. So for every 1 by 2 by 1 butterfly that you put on, your total risk would be $104 plus any fees that you would have to pay to get into the trade. And our upside would be the $5, the width between the spread from 245 to 250. Now, that means that at expiration, you went out right at 250. So I always like to say, if you're doing butterflies and you hit a home run and you get the entire amount of the trade, the maximum that it could trade for, which is $5 in this instance, that you should also get the stupid award for that, because you really shouldn't be in the trade that long. If it hits that strike and you have an opportunity to make a couple of dollars as opposed to $5 on the trade, you need to get out of it, because the odds of it just hanging right on that strike, and the only way you're going to get the maximum is if it goes out at 250 right at expiration. So have a realistic expectation as to how much you can make on the trade. If I put it on for $1 and I could sell it for $3, I am definitely out of this trade. And that's the way that I'm going to look at that. That means I would make double as to what my maximum loss was, which was $1. So just simple math. If you want to keep it simple, that's one way to look at it. Okay. Now, I sent this to the what if calculator, and this will explain what I mean by stopping short, right? This is truly a modified butterfly. Now, when we're talking about skip strike butterflies, which some people call modified, or they call it broken wing, I don't like that term in that scenario, in that if I'm doing a skip strike butterfly, I'm trying to get it done for a net credit. And it's actually, in my mind, I'm thinking of it more as an alternative to a short call spread or a short put spread. In this instance, by stopping short, we're paying a little bit more, but we get a heck of a lot of benefit, right? So the market right now is at 242.69. If the expected move, let me jump back. I'm going to jump back here just for a second. The expected move, $5. Let's call it 10.50. Okay. So if you buy the most at the money, the most at the money call and the most at the money put, you're looking at paying about $10.50. If we run back to the what if calculator, that's putting you 242. Let's call it right in this range, 252. Actually, we're right where we'd be at. So we're right about where we would want the market to be at this point in time. Now, remember, it was a few points lower on Friday, and it's a little bit more expensive. So if I were to put this on today, I would adjust it up, get the cost back down to about $1. And right now, well, it's $1.17 right now. So the market has moved a little bit to the downside, but I would just adjust it, maybe move up to the 247.50 strike, be my first option contract that I would buy somewhere in this range. And that's the way that I would set it up. Trade somewhere around $1. And if I could get it for a little less, maybe do that. All right. So if they blow the numbers away and moves double the expected move on the upside. Now, remember, expected move has no regard for direction. So I want to emphasize that. But then you have the potential, and I'm going to look over here. This is where the profit and loss is at. Right here, it's saying 118 based off of today, paying 117 for that trade. Now 113. You can make $118 if they blow the numbers away. And the middle point, we can make 365 up here. That's the maximum we could make on the trade based off of the width of the long call spread minus the net debit paid. On the downside, we can lose what we paid for it. And it's saying right here that we paid $1.32. So on the downside, if the market opens up and it goes down, expect to lose the maximum. You might be able to adjust if you move really quickly, or even just try to sell out, maybe. But more than likely, if the market perceives the news is bad and the market goes down, you're pretty much out what you paid for it. But we manage the risk by doing the butterfly. So that's the trade. And if you have any questions on it, you can feel free to put them in the chat box. If you are on the Tradier YouTube channel, you can ask questions directly inside the chat box. If you are logged into the Tradier hub, you can ask questions inside the hub. You have to log in order to do that. You can also view this on x.com. It's streaming live through through the Tradier x.com handle, and also through my handle, which is at Brian Overby. All right, so now let's look at a trade for this week. Like I said, waiting around to try to talk about the VIX trades going into next week, hoping the VIX will stay down in this low level. I do think it's too low right now, below 15. But then again, we've had a real strong market move to the upside, but 15 volatility feels low to me. All right, so here's what we're going to do in the SPX. I thought about doing an iron condor. I had that concept in my head, but the more I looked at it, I think I want to adjust that trade. We're going to use the Friday expiration. So this Friday is going to be August 23rd. So here's the 23rd. Here's 4 days remaining. You have you have 0 DTE options in the SPX, so you have every single day of the week that you can trade. We're going to go to Friday. We're going to just do a at the money long call spread. I like this trade a little bit better because you can make the adjustment on the trade. And I feel like the markets are going to just kind of settle in right here. I'm not necessarily bullish on the marketplace, but we have an alternative trade, and time decay is going to be a huge issue. So here's what I'm going to do. Okay. We're going to buy the 55.60 call option on this expiration, and we're going to go 15 points wide, and we're going to sell the 55.75. Now, this just shows you the premium. Even though we're at a 15 VIX or just below a 15 VIX, we're going to buy this long call spread, and you're still going to receive $34 of time value on the option contract that we're selling. Now, on the one that we're buying, I always like to keep the intrinsic value column up. So we're paying $28 in extra. Well, we're receiving, well, I guess paying would be the right word. We're paying $28. The remaining amount between 28 and the current price would be intrinsic value, actual value that's in the S&P 500 index. So in this scenario, we're buying less time premium that we're selling. And that behooves us because then that makes our break even below where the current marketplace is at. And let's call it 9. That's nice. That'll make the math real simple. Let's say we could execute this for $9. You take $9 plus 55.60, and our break even is then 55.69. And you'll see that the marketplace right now is at 55.74. So the market can actually come down, even though we're paying a debit for this trade, the market can actually come down and we're still profitable on the trade. We just need it to stay above 55.69. Now, if I'm setting up this trade and the market does go down and it goes against me, let's say it goes against me hard. Right now, 20 points is about 1/3%. Let's say it goes 0.5% down. That's feasible. That's 40 points to the downside. If I'm 0.5% down from this point on, after we execute this trade, my next adjustment is I'm going to roll it into an actual butterfly. That will be 15 points wide. It does not cost me anything because we are, in other words, it does not cost me any additional margin to do the trade. But if I wake up and say we're down 0.5%, or let's say 40 to 60 points. We wake all of a sudden, boom, turn around, we're up 20 points right now, and blink of an eye, we turn around and we're now down 60 points. At that point in time, I'm going to look at just selling this and end up with a butterfly, hoping that the market can come back, bringing in a net credit, reducing the risk on my trade to put the trade on. And that's the way that I'm going to adjust this trade. Now, sometimes if you don't like this amount, this $9, this $900 upfront cost on the trade, then you can go 10 points wide. And you're going to probably cut this in half by going 10 points wide. So it's up to you about the amount of risk that you want to initially put on. But the adjustment is always harder if the market does go against you, because then you're hoping that the SPX comes back and lands within the strikes of the butterfly. And if you have a 15-point wide butterfly, you got a 30-point wide width that the market could land within. You obviously got to take out the net debit that you paid for it, but that's the concept in theory. So this is going to be the paper trade for this week. We already have our adjustment in place. If it goes up, yeah, we know where our upside is at. We're paying $9 for a 15-point wide butterfly. So the maximum that this can trade for is $9. The maximum we can make on the trade is then $6. 9 plus 6 is 15. That's the maximum we can make on the trade. If we are up about $4 on the trade, we're just going to get out of the trade. I would actually put in a limit order for a net credit if I'm going to unwind this position of around $13 and just leave that and let it sit in there. I'm going to look at the adjustment every single day that goes by. If the market just stays within this range or creeps forward, we're going to get a huge rate of theta decay. We're going to have a huge rate of time decay. So just a couple of days goes down the road, we can probably make $1 or $2 off of time value and time decay on this trade. Okay, so I'm going to send this one to the what if calculator. All right, and then we're going to come back and I'm actually going to look at the adjustment too. Okay, so let's send that one to the what if calculator. We're going to go back to the trading page, and if we did end up doing the butterfly, I'm going to remove this leg and we'll go 15 points wide here and we'll buy that one. I almost hit send. I wanted to send that to the what if calculator and pull that down. All right. And that would be our adjustment on that trade. And then we would end up with our butterfly, which would be buy, sell, buy, and send that to the what if calculator. All right. Zoom in. Zoom in. Zoom in. So here's the way the trade will look. Market is right here. 55.74. We'll just get rid of the decimal. 55.74. Market's right here. Market stays here, goes higher. We have a huge rate of time decay from this point on. Every single day that goes by is like that ice cube melting in the sun of time decay. We've sold a lot of time premium here. And that is going to be our friend on this trade, even though we paid a net debit. Market goes against us. It goes from here, it starts going down. Short vertical spread. If we do this trade, right now we can get this done for a net credit of $1 to the, oh, that's the butterfly. Yeah, that makes sense. How is that? This is that trade. Okay, so if we do this trade, this is going to be our alternative. I don't have the net credit here, but the net credit would be much higher. If the market goes down this direction, then we put on this trade, and then that ends up, we go long, we go short, and we end up long the butterfly. And the way that I want to look at this adjustment is if I paid $9 for the trade, let's go back and look at the short vertical. Let's add that one in just to make the world simple. Let's clear this out. We're going to sell this and we're going to buy that. Okay, so that's $8. We paid $9 for the long call spread. This is trading for $8. If this gets down to around $4, between $4 and $5, that's when I'm going to sell it. In other words, if the market goes against me, the market goes down on the short call spread, I am going to wait because this is going to be my hedge, and I'll put this on and I'm going to take half my risk off the table. If I paid $9 for the long call spread, if I can sell this, let's make it half. Let's make it that simple. And this price comes down to about $4.50. Then I'm going to roll into the butterfly. And then at that point in time, I need the markets to come back. But I'm going to make one adjustment. I'm going to take half the risk off the table. And then I have a chip in a chair. And I'm going to hope that the marketplace comes back and lands somewhere within the strikes of my adjusted or my legged into butterfly in that trade. All right. So that's our trade for this week. This is one of my favorite things to do in the SPX when I feel like the market is neutral to bullish on the marketplace. Obviously, you're buying a long call spread, so you'd rather be more bullish than neutral. but you're still selling a lot of time premium. And if I'm doing this trade, this is the way that I'm going to approach it. That's simple. That's straightforward. And if you have any questions, comments, put it in the chat box. If not, we'll see the Lowe's earnings tomorrow, see how our trade has done. So far, so good, right? We're up a little bit on the trade going into that earnings report. Hopefully the momentum continues in the retail space. And we'll see you this Wednesday for the next edition of Options Guy TV. Wednesday's a great day to adjust SPX trades. So we'll look at this and see if we need to adjust it. If the market continues on up and we get a little bullish favoritism going into the conversation with Jay Powell on Friday, well, then life is simple. Thanks for stopping in. We'll see you this Wednesday for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.